A recession is coming in 2020, sell your stocks right now. No, I'm just kidding, guys. I'm not one of those doom and gloom channels that just thinks that a recession is going to hit every single year. But on the flip side, you can't ignore the facts and the data presented to us that suggests a recession is possible in 2020. But wait, that's not a bad thing. You should not be scared of the word recession. And in fact, in this video, what I'm going to do is show you guys, even if you buy stocks right now at the peak of the market, how in 3 to 5 years you will most likely still be fine and actually come out profitable. So let's walk through those steps today. And no, I'm not going to cover all those indicators, those recession indicators like the yield curve or unemployment rate or anything like that in this video, because really the bottom line you need to understand is absolutely no one out there knows when a recession will hit. It could hit tomorrow, it could hit next year, it could hit 10 years from now. No one knows, and if anyone tries to tell you otherwise, you make sure that you unsubscribe to that source of information. But regardless, economic cycles are a thing, and it doesn't hurt to be prepared in a late stage of an economic cycle. Whether that means a recession will happen or not, being prepared will always leave you in a position where you can take advantage where the recession hits, or you can even take advantage if the recession doesn't hit because you are still invested in the market. Guys, this is going to be one of my most valuable videos on this channel. Make sure to share it with a friend. Make sure to drop a huge like on this video. If you're brand new here, make sure to subscribe as well. I really think this video is going to change your mindset on recessions and will actually make you a lot more comfortable if you do have a recession in 2019, 2020, or even further. So let's kind of start off here by studying the charts from the last two recessions that we've gone through, that being the year 2000 and 2008. This will kind of give us a better idea of how markets behave during a recession, and by being aware of this before a recession hits, you can actually better prepare yourself for a recession and kind of plan out what you need to do during the recession. So this right here is the SPX, which is pretty much the S&P 500 index. And you can see here exactly how it performed during a recession. During the 2000 recession, it took 6 to 7 years for it to recover back to its peak, even after dropping 50% in 2000. This is also true for the 2008 recession, where it dropped 57% and again took around 6 to 7 years to recover. So in other words, this really means if you had bought right at the peak, you would have been down 50% or so on your investments at the very bottom of the recession. But guess what? If you had just held your investments, held your positions, you would have recovered all of those losses back in less than 7 years. Yes, this is a long time to wait to recover losses, but the point here is that if you invest in solid blue chip companies that are well known and stable companies, chances are that they will recover over time. And this is exactly why I always advocate for long-term investing. Because over the long term, stocks are usually on your side, but in the short term, stocks could go against you. So now you might be wondering, well, at the beginning of this video, I did say you could actually break even or make a profit in say 3 to 5 years during a recession. So now let's kind of go over the strategy that I would use during a recession personally. So let's say that you were very unlucky, you didn't try to time the market, but you went in, you started investing right at the top peak of the market right before it crashed and we entered a recession. Let's for example say that you bought shares in the SPY, which is an S&P 500 ETF. Well, let's also say that you watched this video and you were cautious and you're like, well, you know what, I want to invest, I don't really want to time the market, I don't know when a recession is going to hit, but I do want to have some exposure to the market just in case stocks keep going higher. So I'm going to invest, but I'm still going to hold 50% of my portfolio worth in cash. So now let's say as the markets were plummeting, you ignored the noise, you just stuck to your strategy here, and as stocks were going down, you were waiting for an opportunity to buy some more shares, and finally once the stocks were down a certain percentage, you put more money into that position and you bought more shares. Say for example, you bought more shares of SPY at $115 per share. Now the key here is that you're only going to be using half of your available cash to buy these shares, because you're going to use that remaining half to actually buy if we go even lower. So let's say that we bought these shares, we kept holding, stocks kept dropping, and then finally we got to a point where we're like, okay, you know what, we're gonna buy some more shares now. So say we threw in a remainder of cash sitting there and we bought more shares at $80 per share. Now, of course, we're never going to be able to time the market and catch the absolute bottom. And as you can see in this case, that didn't happen and we dropped down to $67 per share, but we were close enough with our entry at $80 or so. So now what we do is try to do some math here to figure out where our new cost basis would be. So say we initially had 10 shares at $157.25, which is where the peak of the market was here in the SPY. This equates to around $1,572.50 worth, meaning we have an equivalent $1,570.50 sitting in cash as well. Now we take half that cash, $786.25, and buy more shares at $115 per share like we talked about. and this would equate to around 7 shares or so. Great, now we have 17 shares in total. So let's continue on with this and say the market went even lower like we said, and we use our remaining $786.25 to buy more shares. This equates to roughly around 10 more shares. Now in total, we have around 27 shares. But now here's the magical part. Thanks to us averaging down, ignoring the noise, sticking to our strategy, our new cost basis here is actually $116.48. This means we brought our cost basis down initially from $157.25 at the peak all the way down to $116.48 here just by averaging down our position over time. And get this, from our peak, we've actually now broken even in about 3 years or so, as opposed to 7 years initially if we just held and didn't buy any more shares when the market did drop. And this is exactly where the saying, buy when others are selling, comes into play, because when others are selling, stocks are cheap, you buy them for cheap, and then over time you will profit. And this exact scenario was true for the previous recessions as well, and will continue to be true for future recessions as well if history tells us anything. The question you gotta ask yourself is, where do you think the economy is gonna go over time? Is it gonna go up or down? In my opinion, it's going to go up, whether that's in the next 10 years, 20 years, 30 years, whatever that is, the economy is going to be trajectory up. They're going to have some pullbacks once in a while, which are typically recessions, but overall the trend will continue being up. And guys, this scenario that we just walked through actually takes into the account that we didn't add any more money into this brokerage account. If I was being 100% realistic here, I would have most likely added a lot more money during the recession into my brokerage account, which would have actually resulted in my cost basis being actually much lower here. And that's another advantage you have by holding a good amount of cash and just pouring more cash in during a recession. And this strategy even works for individual stocks if you didn't want to invest in an ETF, for example. As long as it's a strong company, a strong business, blue chip company typically, you will more likely than not see this recovery in that stock over time as well. Now, of course, there are some companies that may take a very long time to recover, some may never recover, but that's kind of where your judgment of fair value and valuing a stock comes into play. You typically don't want to buy these super overpriced stocks, especially during the late stage of an economic cycle. You don't want to buy these super high valuation companies because they may not get back to that level for a very, very long time. If you're buying companies that are fairly cheap right now, but you think will continue to be dominant in the future, there's not much downside there in my opinion. And when there's fear in the market, it's usually a very good time for you to step in and actually scoop up shares. And a perfect recent example of this, if you've been invested in the last few months or last few years, is that you know that in December we had a massive correction here where stocks dropped almost 20%. Some stocks dropped much more than that as well. But since then, we've actually recovered from that and we're up well over 30% or even more in some stocks. So it just goes to show you that when you sit on the sidelines and you average down when the market goes down, over time, more often than not, you will come out on top. So really, you need to understand that as long as you're investing in these safe companies, or if you don't want to pick individual companies, just invest in the S&P 500 ETF. As long as you do one of those two things, you're typically pretty safe with your investments over a long period of time. So really what I would say is that at this point right now, as I'm recording this video, if you're watching, you may want to have around 40 to 50% of your portfolio in cash. At least that's what I'm doing personally. Because if a recession does hit in the end of this year or maybe in 2020, you're well positioned for that and you can actually take advantage of that. Right now, I don't really see many deals out there in the stock market, which is why I have such a large cash position as well. But when I do see deals, I do end up scooping up shares. I do end up adding to positions that I already have. But as it stands right now, there's not many deals out there as there were back in, say, December. So really the bottom line here is if you take one thing away from this video, is keep a lot of cash on hand just in case we enter a recession in the near future. But at the same time, continue to stay invested because timing the market is a fool's game and you're most likely not going to win that over the long term. So the next time you hear someone say, I hope we have a recession, your thought should be, I hope we do as well, because when we do have a recession, that's when stocks go on sale and that's when you get incredible deals on them because you're positioned to take advantage of that. Guys, make sure to share this video with a friend who gets spooked easily. Maybe they're a new investor. If they're afraid of the word recession, watching this video will actually help alleviate a lot of their fears and will actually make them more rational thinkers if and when we do get a recession. The more people that we educate now, the stronger we can stand during the next recession. If you're wondering what ETF to invest in, make sure you check out this video right here. But either way, I really do hope you found some value in this video, and if you did, drop a huge like. I'll see you in the next one, guys. Thank you so much for watching. Don't forget to invest positively. Peace.